It's a pleasure to be here. This is a paper that I wrote a couple of years ago with two co-authors, Danielle Paravicini, who was here at Columbia and is now at a London School of Economics, and Jose, who's at DePaul. Okay? And one of the nice things about presenting here today is that normally when you publish a paper in academia, that's exactly when you stop presenting it. And that's kind of the moment when you feel like you've perfected it in a way. So it's slightly frustrating. So this is a little bit like a victory lap in that sense. Okay? So let me start off with some very big picture motivation. Because what I'm going to do in this paper is talk about loan offer incentives. And that sounds extremely narrow and very focused. And I want to tell you why would we care about that question to start with. Okay? So this is data from an old paper which looked at the way that corporations around the world finance the investments that they take. Okay, and so this is taken from the flow of funds statistics. And if we look at the US, what does it tell us? It tells us that about 85% of, or $85 out of every 120 or so that's used to fund investment comes from retained earnings. Okay, there's a little bit of money comes from bond financing, some money from loans, and a little bit of money by issuing new shares. Okay, and these cancel out because the corporate sector also provides credit or financing to other parts of the economy in other countries as well. Okay, what is the big point that I'm trying to make is that most investments that a company makes come from money that it has within the firm already. Okay, and in fact, if we sort of organized finance departments around the world to match this data, then about a quarter of us would study banking, and the rest of us would study internal capital markets. Internal capital markets just being the way that a company allocates money within the organization. Okay? In fact, in reality, most of what we study is banking and then these other markets, how companies raise money through selling bonds and stocks. And we ask the question, does the market do a good job in sending more money or less to the companies that have better projects? And we have a lot of research on that. What we know very little about is what's going on within the firm. Do we have reasons to believe that the company does a good or a bad job in terms of allocating the money within across the divisions or the different projects that it may be operating? And as a standard working assumption, we normally think, well, you know, everything within the firm is known, there's perfect transparency, so within the firm we just take whatever are the positive NPV projects that we have, and that's the end of the question. Okay? But if you think about it for a minute, most companies are very big organizations. That's not an obvious assumption that you want to make at all. There are a lot of people with their own vested interests who may not be accurately reporting what's going on in their division, in the job that they're working on, and that may then lead to inefficient allocation of resources within an organization. All the reasons why we think markets are in a way very good and better than bureaucracies apply here, given that most of this money is actually going on, is essentially being allocated within a very large bureaucracy. So our big picture motivation is answering the question, do we see impediments to investment within firms? In particular, we're going to ask, is it related to informational problems that occur within firms? And what could firms possibly do about it? Okay, so the more focused motivation here is we're going to look at a setting where agents have an incentive to underreport bad news. Okay, and you don't have to be a rocket scientist to realize that a lot of people are going to want to do that. So Arthur Andersen obviously destroyed a lot of documents that they had regarding Enron. There's plenty of evidence that police underreport crime, that fund managers adjust the portfolios that they're managing just at the time when they have to report on how much risk they're taking, that teachers provide answers to students so that it looks like their performance is better, on and on and on. Okay? So what we're going to do here is we're going to look at how important is that in a corporation, how important is it that people just don't report accurately what they're doing, and we're going to look specifically through the lens of rotation. Okay, so we're going to use the fact that the people here have their tasks reassigned every so often, and it's not surprising that this might be a way of getting at this issue of how good information flows within an organization. We see that rotation is used regularly in many organizations to combat these sorts of problems. Okay, so in the auditing, we have auditors are rotated on a regular basis as mandated in many countries and was mandated under Sarbanes-Oxley. S&P and Moody's periodically rotate their analysts, and we could keep going. We're going to look in the realm of commercial lending, and we're going to look at a bank that mandatorily rotates its loan officers every 3 years. Okay, and the basic idea is that if I replace David with Charles, then I get another reading on the work that David was doing. Okay, so if Charles comes in and says, you know what, this is a huge problem, there's a problem with this loan, then I learned something about what David was doing, and the threat of that will then incentivize David himself to perhaps tell the truth more often, because he realizes that he might be ratted out by Charles in the near future. Okay, so I'm going to be pitting you two against each other. Okay, so the question that we're going to ask then is, does task rotation affect the reporting of these corporate loan officers? And then we're going to try and ask, well, what is the agency problem and how does rotation solve that problem? Okay. Now, when I say rotation here, I want you to be very clear in your mind about what I'm referring to. Okay, so this is going to be the bank. And let's think of there being two loan officers within the bank, and they each are managing a portfolio of loans. Okay, so A and B are managing, A is managing firm 1 and 2, B is managing firm 3 and 4. And rotation is simply this firm is reassigned to loan officer B. Okay, and that's going to happen periodically here. That's when essentially the task is handed over from David to Charles, and I'm going to start learning about what Charles is telling me about the work that David was doing earlier on. Okay, so that's what rotation is going to look like in this setting. Okay, what we're going to do is we're going to use the fact that rotation occurs here every 3 years. There's a rule that determines that, and we're going to basically show that that when I'm about to hand my information, the loan that I'm managing over, then the threat of being ratted out by my successor induces me to report more accurately. Okay, I'd like to keep bad news suppressed, but if I know it's coming to the end of my time and someone's going to be replacing me, I'm going to report more accurately. Okay, and we're going to argue that's because of the career concerns of the loan officers themselves. Okay, that reporting bad news reflects badly on your career, and you end up managing smaller portfolios when you have to announce that. But it's better off to own up to it than have someone else rat you out later on. Okay, so that's the basic way that we're going to argue. And remember, this all goes all the way back to then arguing that within this bank then there must be a considerable problem figuring out who are the firms that we want to lend money to if the loan officers who are meeting with those firms on a regular basis are not reporting accurately up the organizational hierarchy who's profitable and unprofitable. And that's the sense in which this goes back to that much bigger question: how well does information flow within an organization, and how efficiently is capital going to be allocated as a result? Okay, so let me describe the data a little bit, only because this is a unique data set that we were very lucky to have access to. So the data that we're going to use here is from the operations of a multinational bank where under privacy agreements we're not allowed to say who they are, but this is one of the largest banks in the world, okay? And this is from their operations in Argentina, okay? We're going to be looking at their small to medium-sized lending division where their borrowers have sales up to $50 million. And this is at a time of dollarization, so we can read those in US dollars right away, okay? So what do the loan officers do here? So they meet regularly with the clients. They approve amounts of lending periodically when the firms want to borrow more money. And they recommend those lending terms. And they also assess the riskiness of the loan every month. And that's going to be the communication that we're going to look at, and we're going to figure out how accurate is the rating that the loan officer is assigning. Okay? There's in fact two ratings, one that's based on just hard information, so information from their financial statements and so on, and one that's based on a sort of more qualitative judgment on, you know, the meetings that they're having with the management when they go out and visit the business and so on. And this is going to be the one where they could essentially fudge something. I can't lie and put a different number here, but I could say, you know what, I've gone out and I've seen the business, I think things are going well, I'm going to give them a fairly safe rating. Okay? All right, let me, what I want to say here is that we have data on 100 loan officers who work in this division, who in total are overseeing loans to about 1,200 firms. And we know each month over the sample between the end of 97 and the end of 2004, we know the loan officer who was assigned to each and every firm. So I can see when the loan goes from being under the responsibility of David to Charles and on and on and on. Okay? And we also see the rating that each of the loan officers is assigning to each and every one of these clients in each month. Okay, so this is very unique and very valuable in the sense that we don't typically have data on the communication that's going on inside an organization. One of the advantages of this setting is that we know what internal risk ratings are meant to do. They're meant to predict default. So we're going to be able to look at how well do they do that, and therefore figure out how accurate is the information that they're reporting to their to the higher ups in the organization. Okay. In addition, we're going to be able to match all this data to data from the bank credit registry, where we'll know the ratings and the amount of lending that other banks in the same economy are doing, so we can talk about how the ratings are changing relative to the ratings being assigned by other banks, which means that we can control for stuff that might be going on at the firms that's unrelated to what's going on here. If the firm is just doing badly for other reasons, then this will be reflected here, and it will only be in differences between the two that we can assign to the lying of the officer himself. Okay? So the main thing that allows us to do our work here is the fact that rotation occurs according to this 3-year rule. And if you look at the manual of this bank, which applies globally, they recommend that the maximum length of a relationship between a loan officer and a firm should be 3 years. Okay? And here we plot the probability of a loan being handed over at any point in time over the assignment of a loan officer. Okay? You'll notice straight away that there is rotation, that loans are handed over all the way through the life of the firm. Okay? So it might be that after a year and a half, there's a problem at the firm, and they decide, you know what, Andrew, you're not the best person to be assigned to this. We're going to go and assign this to David, and so on and so on. Okay? We wouldn't want to draw associations between rotation there and what's going on in terms of the rating, because it's probably driven by reverse causality. It's probably that the firm is doing badly, the rating is getting worse, and that's why we're handing the loan over. Okay? So in general, telling you that there was an association between rotation and the rating, you wouldn't know how to break the chicken and egg problem. Is it the rotation driving the rating or the rating driving the rotation? Okay? What's nice is that exactly 3 years into the relationship, the probability spikes in a big way. So conditional on getting to 33 months into a relationship, there's a 58% chance that your loan is going to be reassigned to somebody else. Okay? And essentially, within that probability, whether or not your loan is assigned is essentially random. There's almost nothing that predicts whether or not that's going to be you that has your loan handed over to anybody else. Okay? And that's also going to be crucial to our analysis, and we spend a lot of time in the paper showing that that is indeed the case. Okay? So here, what's good about this is that's not because there's anything going on at the firm. It's not because they're particularly in trouble. It's just because of this mandated rule. Okay? So now I know I can draw causal inferences from the rotation to the reporting behavior of the loan officers. And even better is that I know that the loan officers are expecting this to come, so how their behavior changes as it draws nearer tells me how they respond to the anticipation of having the loan handed over to somebody else. Okay? So let me just tell you a couple of things about the data. So on average, these guys, so the median firm here is borrowing about $200,000 from our bank, and in total about $1.3 million from all the banks in the Argentinian economy. Okay? On average, their risk rating is 1.54, so a number of 1 is in good standing, and then number 2 is a qualitative assessment that you might be in some trouble, and then as the numbers get higher, that's when you've already missed a payment and so on. Okay? But the main discretion is between whether the officer assigns a 1 or a 2. That's the real margin you should think about. Okay? There's only about 9% of these guys in default, so I don't want you to think that this is Argentina and the wheels are falling off all these companies at once. And these risk ratings in general are meaningful. So companies who are assigned a 1 have only a 10% chance of defaulting in the next 12 months. Okay? Companies who are assigned a 2 have about a 37% probability, and so on. And it's essentially the difference between these numbers that basically accounts for the information content in those ratings. If these probabilities were the same, then basically ratings were being assigned in a meaningless way. Okay, we wouldn't be learning anything. All right, so let's ask the basic question here. Okay, so I've blotted out all the equations which kind of take care of all the statistical stuff, but the basic question we want to ask is, does imminent rotation induce more informative reporting? Okay, so is it the case that when I anticipate this loan is soon to be handed over to someone else, that I start reporting more accurately? Okay, and what we're doing here in words is essentially estimating the information content of these ratings, or put in another way, how much predictive power they have for default over the next 12 months. And that's given by this solid line here, and the confidence intervals, the 95% confidence intervals are what I'm plotting around that. Okay, what can you see? So over the life of the loan officer's relationship with the firm, the ratings become progressively less and less informative. Okay, not what you'd really expect if you thought that the guy was just getting better and learning more about the firm, but instead indicating that the guy is handing over less and less accurate information about what's going on. Okay, this is particularly strong in the loans where the guy has done a lot of additional origination. Okay, so has essentially lent a lot more money, is of course then very reluctant to say, you know what, that loan I made 6 months ago doesn't look so good. I'm not feeling very good about this firm. Okay, so that gets to about 2 years into the relationship, and then I start worrying because now in this period here, the loan is probably going to be handed over to somebody else. What do we see? We see that the information content of these ratings starts increasing dramatically. Okay, so when this coefficient is 0, I'm learning almost nothing about the probability of default from being assigned a 1 or a 2. And when the coefficient is up here, it's about 30% more likely you're going to default when I see a 2 relative to a 1. Okay. In fact, this pattern here is what you see if you look at all the firms as they come up to this 3-year rule. But here what I'm actually doing is I'm plotting the guys for which rotation never even occurs. So you might imagine there might be a kink because simply when David hands over to Charles, Charles has a different ability or something like that. All that's going on here is that we're actually looking at the subsample where David anticipates that the loan will be handed to Charles, but then we actually decide, you know what, David, you can keep working on it. Okay? Well, what do we see? Well, David was worried that something was going to happen. He started reporting better news. And then as soon as he realizes that isn't the case, the loans start, the rating starts becoming less accurate again as well. And it can't be that this change is induced by the fact that any actual change went over. The loan remained in David's hands. All that happened was that he was freaking out, thinking that he might have to hand it to somebody else. Okay? Next, we can look at how does the average bias in ratings change, and it's basically exactly the same pattern. So you see that the ratings become lower. The lower number here is less risk, and then they get larger as the rotation rule follows. Okay, basically saying that it's extra bad news that's coming out that's driving this pattern. Okay, all right. So to make sure we have plenty of time for questions, I want to highlight one more set of results that go to the basic mechanism that we think is in play here. Okay, so why is it that these ratings are becoming more accurate? Okay, well, let's think about what my original story was. My story was that I don't want to reveal bad news because it reflects badly on how I've been doing as a loan officer, but if I'm soon to hand this over to somebody else, I'd rather own up to the mistake than have them essentially rat me out. Okay, so do we see my career being impacted in ways that are consistent with that story? Okay, so what am I estimating here? So the first number there is essentially how the size of my loan portfolio as a loan officer changes when I report bad news prior to rotation. So in the 6 months leading up to the 3-year rule, we see that the coefficient there is minus 0.14, which means that 14% of the time I'm going to lose one firm in my portfolio. On average, these guys are managing about 10 firms, so that's a pretty sizable drop in in how many firms I'm managing and on my future career. Okay. However, so compare that to what happens if I don't own up to it and my successor points it out in the 6 months after the loan is handed to me. So this is when David has not revealed bad news, but then Charles downgrades the loan in the first 6 months of his assignment. What's the effect on David's career? It's more than twice as large. Okay, so it's negative, but it's much more likely that the bank is going to say, you know what, David, someone's ratted you out. We're going to punish you in a much bigger way, and we're far more likely to take one of those firms off your hands. Okay, and finally here, this is the effect of announcing bad news earlier in the life of the relationship. Okay, it's still negative, which is the reason why I'm lying in the first place, but it's smaller because I bear less responsibility for the loan, and also the bank is essentially assessing, well, at least this guy's smart enough to recognize that there's a problem and honest enough to reveal it right away, whereas later on, it may be that the guy took a long time to figure it out, or that he's dishonest, and so we're seeing his career impacted more as a result. Okay? All right, so we also see that the effects are stronger when you're younger. So you would expect that if when I'm younger, I'm more worried about establishing my reputation within the bank. If I've been there for a very long time, then my reputation is pretty solid, and I don't need to lie as much. We also see the results are far stronger for loan officers who've originated a lot of lending over the course of their assignment. Okay, if the loan was just handed to me and I'm managing a loan that somebody else made earlier on, then I don't have a lot of reasons to hide any bad news because it isn't my fault. Okay, someone else originated those loans. If I did a lot of the origination, then the results become a lot stronger. Okay, so the basic conclusions here are that there is the paper provides direct evidence that there are significant agency problems in communication within a firm, that it's very difficult to get agents inside an organization to accurately report information to each other. In results that I didn't really talk about here, we show that then impacts how accurately the bank can, or efficiently the bank can allocate capital across the different borrowers that it faces. We argue here that it's because of career concerns, that people don't want to report on doing poorly in their jobs, and that means that information is withheld as a result. And we argue that rotation is one effective organizational response to this. But to bring it back to the original motivation, it really tells us that we need to learn a hell of a lot more about what's going on in terms of the efficiency of the allocation of capital within these very big organizations in our economy. Okay? Excellent. Thank you.